You've probably heard this one. Mutual funds are subject to market risk. But what if I told you there's one fund that's practically become a celebrity in the investment world? Yes, we are talking about the Parag Parikh Flexi Cap Fund. The one your CA uncle, your startup friend, and everyone on the internet keeps talking about. Let's break it down today. This fund was launched in May 2013. It's part of the FlexiCap category, which basically means that the fund manager gets full freedom to invest across large cap, mid cap, and small cap stocks. No restrictions, no size limits. Sounds flexible, but that's the whole point. Now, this isn't just your regular Desi fund. It has an international passport. A big chunk of your money goes into the global tech giants. We are talking about Alphabet, Meta, and many more. So, yes, it's a bit of investing in both Mumbai as well as Silicon Valley without the visa issues. Of course, with the great flexibility comes a little higher risk. This one sits right on top of the riskometer. So, if you're someone who panics when your portfolio is a little in red, take a deep breath. Now, let's talk about the costing. This fund, the total expense ratio is close to 1.28%. It's not cheap, not even outrageous, especially if you believe in long-term compounding and smart investment management. Its benchmark is Nifty 500 TRI. It's trying to beat the benchmark, and so far it has done a pretty decent job. But hang on, before you go rushing to start a new SIP, let's pause, because in the next part we will be talking about the real stuff, the performance, the drawdowns, and whether this fund is still an overachiever or it's time to let this fund go. Alright, so now let's have a look at the screen here. We have changed the benchmark to Nifty 500 TRI because this fund invests across large cap, mid cap, and small cap stocks. So Nifty 500 is the right benchmark. Now, if you check this out, if you had invested 1 crore rupees in Parag Parikh Flexi Cap Fund back when it had launched in 2013, you would be sitting on 8.5 crore rupees today in just a span of 15 years. That's the kind of compounding we are talking about. And it just doesn't happen by chance. The fund has delivered an annual excess return every single year. But hold on, let's not get carried away because there is one major red flag and it is worth understanding. The fund does not do great in a rising uptrended market. Just look at the numbers. The up capture ratio is at 80. So what does this mean? If the benchmark goes up 100%, this fund only is capturing 80% of the upside. So in bull markets, it does not outperform. It has never outperformed, it seems, if you have a look at this list. But then how does it still beat the index overall? If you have a look at the down capture ratio, it is only at 50. So what does this mean? When the market falls by 100%, this fund falls only by 50%. It is literally cushioning your portfolio during the crashes. And that's the secret. Not chasing the highest returns when everything is booming, but quietly protecting your capital when the market turns ugly. So when you zoom out for 10 to 15 years, those small cushion during the market crashes, they actually make a huge difference in the long-term compounding process. All right, let's dive deeper now. Let's actually see what's happening inside this fund. First, the equity exposure right now of the fund is about 70%. Out of that, around 10% is in international stocks, mostly big names like Alphabet, Meta, and Amazon. Now, here's something interesting. The latest addition to the portfolio has been Bharti Airtel and Bajaj Holdings, both strong Indian businesses. But what's going to be trimmed? HDFC Bank, Kotak Bank, and Power Grid have been cut down. I wonder why they did that. Now let's have a closer look at the red flag number 2. Even though this is a flexi cap fund, it is slowly becoming a large cap fund in disguise. Let me explain. If you look at the current allocation, 91% of the equity exposure is sitting in large cap stocks. Mid and small caps are almost non-existent. So much for flexibility, right? Also, check this out. The top 5 holdings alone make up for 40% of the entire portfolio. That's quite a concentrated portfolio. And when one of these top 5 stocks will tumble, the entire portfolio will be pulled down and the fund performance too. So what about sector exposure? Banking and finance together make up 28% of the fund. That's a fairly heavy tilt towards one part of the market. But here's the real kicker. This fund is now managing AUM of more than 1 lakh crore. Yes, 1 lakh 3,867 crores to be precise. Let that number sink in. This massive fund size is difficult to manage. It is pushing the fund manager to play safe, to stick to large cap stocks instead of exploring mid and small cap. But honestly, when a fund becomes this big, deploying the fresh cash is difficult. Therefore, if you see, they are still holding 10% in cash. And that's how we get here. A flexi cap fund slowly turning into a large cap fund. So, what should investors really make of this? Is this the beginning of a slowdown in performance, or is there still value in holding this fund? That's exactly what we will break down in the next part. Should you continue to do your SIPs, or is it time to look somewhere else? So let's be clear. If you are someone who values stability, capital preservation, and long-term compounding, then Parag Parikh Flexi Cap Fund still deserves a place in your portfolio. It is steady, it is consistent, and it has proven itself throughout the market cycles. But if you are chasing higher growth, you are looking for agility, for small and mid-cap participation, then this fund may no longer be your best bet. Here's the truth. This fund is no longer a flexi cap fund it used to be. It is morphing into a large cap centric vehicle driven not by the choices but by the size of the fund. With an AUM of over 1 lakh crore, this fund is no longer small, and it has the implications. It is restricting the ability to choose smaller opportunities. It limits the flexibility, ironically, the very trait it was named after. So, what should you do? Stay invested, keep the SIPs going on, but be strategic. Pair this with a smaller, more agile fund, because investing isn't just about the past returns, it's also about staying focused for the future and keep changing according to what is happening in the fund.